Folks, how is it going today? All right. So today we are doing the Live Off Dividends 4.0 calculator, guys. This is an iteration of the Live Off Dividends calculator 3.0 as we've continued to improve it and improve it and improve it. And I'm super excited to show you this version today, guys. Let's just jump right into it. All right, guys. So, as per usual, the Live Off Dividends calculator will be available via the Patreon, guys. If you want to sign up to the Patreon, it is $5 a month to get access to this Google Sheets, among many, many others, maybe tens of almost 100 others at this point. Many, many, many Google Sheets I have posted. Or if you want to do a one on one coaching session every month, it is $15 a month, guys. Please check out in the description the Patreon link. All right. And so, live off dividends, guys. I know this is a concept we talk about a lot. And with the ETFs that we plan for, we plan to, build a strategy that will allow us the yields, allow these distributions to help us live on these dividends. So or live on these distributions. So that is what this calculator seeks to do, but it also seeks to help you understand different market dynamics when the market is doing well for certain years, when it's not doing well, and just really map everything out with reinvestment amounts, with drip amounts, with how much I want to take out and live on. But when it comes to building your plan, the first thing you need to know is your monthly budget and your annual budget, guys. So we've seen this in the past, but this little sheet, step one is to determine your monthly expenses. So you have to add in everything from your housing to your food to your home and purchases, your lifestyle purchases, your entertainment and travel, everything. And in this case, we have lined up to spend about $5,400 monthly and almost $65,000 annually. And you have to adjust this according to your current situation. And then next up, what we want to do, step two, is plan out our portfolio and our respective cash flow analysis. All right. And so this is going to be, in generally speaking, a bull market. All right. And so in this case, we have decided to invest, $605,000. It's a lot of money, guys. If we want to go down to 500,000, you can do so. You can adjust this as you see fit, and you can also adjust your drip percentage, so how much you want to reinvest into this portfolio, instead of withdrawing to live on. All right. And here are the assets I've chosen for this portfolio. It's QQQI, SPY, T-SPY, TDAC, and GPIC, guys. QQQI does a 14% yield, SPY 11% yield, T-SPY 13% yield, TDAC almost 17%, and GPIC 10%. And I've set up allocations, percentage allocations for each ticker, each ETF. I've set up allocations, and then based on this case of 500K, it will allocate the amounts accordingly. All right. Now, do keep in mind that this is during a bull run, right? We're seeing these great yields, 13% average total yields during a bull run. And so on the next, sheet, I want to show you guys what happens during a bear run or a bear market. The things might adjust. So we'll account for that. One thing to note is that with all these assets, we pretty much have 100% return of capital. So we will account for that as well. And based on this portfolio, we're expecting 66K in annual income. We'll have $6,600 to reinvest. Or, if we want to adjust that again, this is all adjustable, right? And so look what happens. If we choose 20% drip, our cash flow down here, right? Evaluating the cash flow, right? Our monthly income becomes 4,400, but our monthly expenses is 5,000. Or even you can adjust it to 5,400. So 5,400. So we're negative 1,000 cash flow. This isn't going to work. So effectively, we need to either reduce our drip percentage pretty low here or increase our amount to invest. Okay. And now a lot of you are going to say, or some people in the comments are going to say 600,000, that is a lot to invest in these assets. They're new, they're unproven. And I would tend to agree with you. You have to do what is right for you based on your situation. If you are comfortable with these funds, based on the fact that they do have the underlying of the S&P 500, and the Nasdaq 100. If you're okay with that, then you proceed with it as per your risk tolerance. But you have to evaluate your own risk tolerance and then make calls accordingly, right? But if you want these yields, there comes with the risk, right? It comes with risk. Okay, so we're going to choose 600K in this case. It is a lot of funds to allocate, but 600K, that gives us room to drip 10%, and still have $6,000 to withdraw to live on, right? So we'll have $6,000 coming in monthly, $5,400 on monthly expenses, and $600 extra cash flow that we can either invest in other assets, or reinvest in this, or do what we please with. All right. So that's the setup. And you can adjust all of these things as part of the Google Sheets. You can adjust these things as you see fit and adjust the yield accordingly. These are the assets that I've chosen. All right. And so here is some of the changes I've made to the what's called future proofing with return of capital. Okay, guys? Because in this chart, it's going to give you guys an example of your starting value and your end value after 20 years. And when it comes to taxation with return of capital, how many years of return of capital do you get in terms of not paying income tax on your distributions, right? And with that, in this case, should we drip 10% of our funds, we will have 7 years of return of capital. So after 7 years of effectively not paying any taxes, will we start having to pay taxes because our cost base will have gone to zero at that time. I will show you what that means. All right, but let's look at all the different factors here. Let's look at all the different data points. So we have our initial investment amount, and then we have our expected bull market appreciation of 3% and expected bull market yield of 13%. We are dripping 10%, as we said. Inflation per year is 2%. So the money that we would withdraw, we will continue to inflate it and account for that. Our ROC return of capital rate is 100%. Ordinary tax rate 15%. Expenses, as we saw on the other sheet, is 65K. And now I've added in a new field here of annual contribution, guys. So if you want to add in more, and this is a request from a user or an audience member, people wanted to add in annually. All right, so I've added in a field here, so you can add in annually. If you want to add in 5K, if you want to add in 10K, you can do so as you see fit. I'm going to put in 10K per month per year in annual contribution, and that will update all these sheets. All right. And then this will be our bear market return, right? And bear market yield. All right. So in this case, again, these are changeable. If you want to adjust these, you can adjust them as you see fit. I'm saying in a bull market, we're going to see a 3% appreciation and 13% yield. But in a bear market, we're going to see a negative 12% depreciation and only 10% yield, which is a negative 2% effective yield or effective total return. And we're here, you're going to add in your down year chance. Okay. And this is going to randomize this. I cannot tell the future. None of us can. But this is going to randomize this based on this probability, right? So I'm going to put 10% or maybe 5% or 20%, right? If I put 20%, right? Look what's going to happen. I put 20% chance of a bear market year, and then this is going to give us a percentage breakdown. All right. It's going to tell us, all right, for 85% of the time, we'll be cash flow positive with a 10% drip and 20% down year chance. All right. So look down here. Some of the years in red are the bear markets, and then all the years in green are the bull markets. All right. So this is a randomized setup, right? And I cannot tell. I don't have a crystal ball. I cannot tell you which years will be negative, which years will be positive. I also cannot guarantee you, of course, these returns, both negative and positive. But we're trying to simulate things here, guys. So we have a 20% barrier chance or down year chance. 85% of the time will be cash flow positive, and 15% of the time will be cash flow negative, right? So that's a healthy balance, right? And we can account for that for this 15% of time throughout the 20-year period. Maybe those years, we can find other cash flow and other resources in other ways. Maybe it's picking up a job, or maybe it's strategizing accordingly to get us to 100% cash flow positive. To do that, maybe we take off drip. Um, all right, this is a randomized thing. All right, maybe we assume that we have a down year chance. right? So we got to account for all things. And this is, this is dynamic. This will change every single moment because it is a randomized factor here. And maybe you assume less bear market, negative weighting, right? We play with it and we make it work. We don't try to bend the numbers to our favor because we want to be realistic, but we want to essentially we still want to be realistic. Okay. All right. So the next step after 20 years, all right, we have our capital gains after 20 years. We have a return of capital amount. And then we have our tax bill, in this case, 600K. And this is the rock years, as I said, amount of years that we'll have return of capital benefits. So that's 10 years. All right. And I want to show you guys something, right? If you were to do 100% drip, okay, you're going to reinvest the total amount every single year. Of course, now you're not withdrawing to live on, but if you were to 100% drip, and this is a question about comment I had in the comments before, you can see what happens to the rock years. We have 32 years of return of capital, so effectively not paying tax throughout the 20-year period and beyond, because we're continuing to add the cost basis back in with the drip amount, with the income. So it gives us effectively 32 years of no taxation as relates to the income. All right, but let's go back to the reality, and that's 10% drip. And so the amount of rock years would still be nine. Very good, not paying tax for 9 years, guys. In this case, the end balance with this setup, 600K, with the setup, with 70% of the time cash flow positive, 30% of the time cash flow negative, we'll have an ending balance of 761K. So not phenomenal appreciation, right? But total income of almost $2 million for a total return of 228%. Okay. So with this portfolio, we're not seeking a lot of capital appreciation. We're seeking no NAV erosion and some appreciation. And really it's about that income so that you could go and live on it and use it towards your lifestyle, right? And so the chart is going to speak to that, right? Year one, 600K starting value, annual contribution of 10K. In year one, we already had a negative 12% return. So really total return of negative 2% in total. The cost basis here, 610K, because we added in an extra 10K. Our dividends, 60K, no taxable dividends. We're reinvesting 6K and we're withdrawing 5,400 to live on. um, we had a negative growth, right? In this case, right? So the end value is going to be weaker at 537K. And so in this case, we would actually have a negative cash flow right off the jump in year one, right? So you can see it how this plays out, right? Bear markets happen, and when the bear market happens, we have a negative cash flow. We have to account for that. Maybe it's a job, maybe it's other sources of income. That's something for you to decide, right? But in year two, what happens, right? The bull market comes back in. We're still reinvesting. The market appreciates 3%. We have a higher yield. We have higher dividends, no taxable dividends as a result of return of capital. We're reinvesting some dividends. And then um, effectively, we are right at a cash flow balance, right? Our expenses, because of inflation, have increased to 66K, but we withdrew 65K effectively. And so we're right there at almost negative 1,500, but pretty much that's right at zero, almost. All right. And then next year, what happens? Again, we have a bull market. All right. 563K. The end balance is 590 with the appreciation, and we have a good yield. And so we're at a cash flow balance, guys. We're now not needing to get another job or whatever the case may be. And with this simulation, you can see it moves on and on and on, where you're going to be cash flow positive in this case until you're, what is this? Year 13, right, where we have another bear period, right? And then because of all the cash flow that you had in the past, you can use that. Maybe you've built a savings account. You can use that towards this negative cash flow year. And then moving forward, we have a number of years that are again cash flow positive, and then a couple years near the end that are cash flow negative based on a bear market period. All right. So and that's also as it relates to inflation, right? So inflation, things would get more expensive. So we are accounting for increased expenses throughout the way here, right? At the end of it, your expenses are 100K. Maybe you adjust it differently and you want to have 150K and you started at 90K, right? You have to decide on that. But this gives us an example of dynamically what will happen throughout the years, right? Not every year you're going to have a phenomenal year yield. Some years you're going to have a weaker or negative total return, and in those years, maybe we still get some distributions, but they're not enough to cover our expenses. We have to plan accordingly. All right, guys. So that is the new sheet in a nutshell. And again, these are all these factors, all these fields are all adjustable. All right. So if you assume, what, actually, it would be a negative 10% and pretty much flat bear market periods, and that will adjust your setup accordingly. um, you can adjust this as you see fit, guys. I will again link this in the Patreon for everyone to utilize. I really hope it's helpful. Let me know in the comments what else you would like to see to this, and I will continue to add to it, guys. To that, guys, all the best. Have a great weekend, and cheers.